Thank you for joining us at xm.com for the weekly outlook. It's going to be a data-packed week, and investors will be eyeing the data releases as to gauge how many more rate hikes are likely to be delivered by the Fed and the European Central Bank. I'm Cristina Marujos. With me today is our senior investment analyst, Geralambos Pisuros. Geralambos, starting with the United States, markets repriced their Fed rate hike bets higher after a string of strong economic data. Therefore, the ISM PMIs for February will attract a lot of attention this week. What are we likely to see in the numbers, and what could that mean for Fed hike expectations and, of course, the dollar?
Hello, Christina. Yes, indeed, following last week's preliminary S&P Global PMIs, which surprised to the upside, it will be interesting to see whether the ISM PMIs will confirm or contradict them. The forecasts point to a mixed picture, with the manufacturing PMI expected to have risen to 47.9 from 47.4, and the non-manufacturing PMI is expected to have declined to 54.2 from 55.2. Nonetheless, given that the services index accounts for nearly 80% of US GDP, another print in the services PMI decently above 50 is unlikely to alter much expectations about the Fed's future course of action. According to the Fed Fund Futures, investors are expecting interest rates to peak at around 5.34% in July, while they see them ending the year at 5.15%. In my opinion, this means that should officials match their December median projection, there is no need for any interest rate cuts towards the end of the year. So, anything adding to hopes that the US is likely to dodge a severe recession could support the US dollar on speculation that the Fed will continue raising interest rates at levels higher than projected in December. That said, arguing about a full-scale bullish reversal in the US dollar remains premature, as ahead of the March meeting, the market will have to digest the employment and CPI reports for February. On top of that, the Fed is not the only central bank for which investors have increased their rate hike bets.
And speaking of which, let's turn to the Eurozone. We've been getting hawkish sound bites by ECB officials lately, and another 50 basis points hike is essentially priced in for March. But could a hotter than expected Eurozone inflation print this week tip the scales for an even bigger hike by the European Central Bank, you think?
Okay, headline inflation in the Eurozone has slowed notably after peaking at 10.6% in October. And in my opinion, it could slow even further in the months to come as the year-over-year change in oil prices continues to slide. However, core inflation, which excludes volatile items of energy and food, is proving sticky, and Thursday's data is expected to reveal only a modest slowdown for the month of February to 6.9% year-over-year from 7.1%. So, combined with the improving PMIs in the euro area, stubbornly high underlying inflation and more hawkish rhetoric by ECB officials could allow investors to maintain bets about a triple hike at the upcoming meeting. Currently, they are assigning a nearly 30% probability for a 75 basis points increment, with the remaining 70% pointing to the telegraphed 50 basis points hike. Investors also see a total of 130 basis points worth of additional rate hikes before the bank takes the sidelines, while just a week ago they were seeing 100 basis points. So increasing ECB hike bets are complicating things for euro-dollar sellers, even if the dollar stays strong, but they also increase the downside risk in the case of an upcoming economic release disappointing. The same goes for the dollar. Therefore, the outlook for euro and dollar seems somewhat blurry for now. Maybe both currencies will perform better against the risk-linked ones, as increasing hike expectations have been weighing on a risk sentiment lately. With the slowdown in Canada's inflation for January confirming expectations that the Bank of Canada may refrain from hiking rates further, the loonie may be the best choice.
And before I let you go, Geralambos, is there anything else investors should pay extra attention to on this week's calendar?
Yes, Christina. I think traders of the Loonie and the Aussie need to pay attention to the Canadian and Australian GDP data for the fourth quarter, as well as Australia's CPI numbers for January. The Canadian data comes out on Tuesday, while the Australian numbers will be released during the Asian session Wednesday. Aussie traders could also closely watch the Chinese PMIs for February, also due out on Wednesday, as given the close trade relationship between China and Australia, they may be eager to find out how the world's second largest economy has been performing after the reopening. Now, from Japan, we have the industrial production and retail sales numbers for January, which come out on Tuesday, and the Tokyo CPIs for February on Friday. Now, at his testimony before the lower house of the Japanese parliament just today, Bank of Japan Governor nominee Kazuo Ueda seemed in no rush to adjust the yield curve control policy. So, as investors try to estimate a possible timing of another tweak in the yield curve, they could pay close attention to the aforementioned data, especially the Tokyo CPI numbers, as they are a very good gauge of the national inflation data.
Hannah Lembos, thanks so much. This was the Weekly Outlook here at XM.com.